Flip, Floss, and Fly, presented by Say It Loud Canada, the ultimate financial literacy program, brought to you by the Black Business and Professional Association and the Donald Reed Estate. Here are your hosts from Flip, Floss, and Fly, Andre Smith, financial literacy expert and poet, Farley Flex, social activist and entertainment trailblazer, and Roderick Brereton, social entrepreneur and conflict management specialist. Good morning, good morning. Welcome to Flip, Floss, and Fly. Another edition. We are so honored to have you within our presence this morning. Thank you very much for joining us again. Please, again, tell a friend to tell a friend that we are on every Saturday morning from 10 a.m. until 11:30. Last week, we actually went to 12 o'clock p.m. and we had the full gamut of everybody with us. So thank you again. And this morning, we have a packed agenda in terms of financial literacy and life lessons that we're all going to take in. And again, we're going to tell a friend all the information that we've learned. It doesn't stay here with us. It goes out into the community and reverberates. All right, that's the new word for today, reverberates. It trickles down. All right, so without any further ado, we've got our host, our financial literacy expert, Andre Smith. Ready to take it away, my brother?
I am ready.
Okay, let's do it. I'm going to.
Yep, just waiting for you to.
I guess that will help. All right. We could start telling them how your trip was and whatnot, and then we'll get right back into that. How was your trip in Jamaica?
Sure. My trip was actually amazing. You know, Jamaica is home for me. Every time I go to Jamaica, I have a great time. I know right now they have the quarantine rules and whatnot, but just being in Jamaica is awesome. The food, the culture. I mean, it's crazy because I feel like a part of me kind of look forward to the, like that sus and mix up in the, like just being able to walk on the street and hear people arguing. I remember one of the time I was in KFC and the woman said, "You don't see me in that line?" And I'm like, "Yeah, I'm in Jamaica." Yeah, so it was a good time. I had jerk chicken. And if you're ever in Kingston, let me tell you, if you're in Kingston, make sure that you go to Standpipe. Michael and I were just talking about it. Go to the Jerk Man across from the US Embassy. Best jerk chicken in Kingston. And if you want good steamed fish, make sure you go Screeches at Elsha Beach, right?
Yes.
Screeches have the best steamed fish, the best vibe. Jamaica is really nice. I can't get enough. Jamaica is home for me, and I'll go back like 10 times for the year if I could. All right. So unfortunately, I'm not there presenting today. I'm presenting from Toronto, but I still love T-Dot. T-Dot is pretty good, right? And as soon as I'm done with this presentation, I'm just gonna chill because technically I'm under quarantine for 14 days. All right.
All right.
So I just have to be a homeboy for the next 14
Literally. All right. So let's get started.
All right. So this week, we're going to be talking about risk, reward, and portfolio diversification. Those are some big words, but we're going to break them down. And we have, Michael and Roderick will ask questions from time to time so that people are understanding fully what we're talking about. And so we're going to continue that. So for those joining for the first time, again, my name is Andre Smith. I'm from Spanish Town, Jamaica. Don't forget the Spanish Town. I'm not no uptown boy. I'm a graduate from York University with an undergraduate degree in accounting, founder of Flip and Floss, which is a financial literacy and investor program, and future leaders obtaining sufficient skills. I actually want to tell you this. I'm working with a team of about 15 volunteers right now to develop Flip and Floss, right? To actually make financial literacy something in Jamaica as well, right? So I want to educate youth in Jamaica, talk to them about business and registering how to register business, how to be financially literate. So I'm actually super excited about the direction of Flip and Floss. And I'm even more excited to have this opportunity to work with the BBPA and Urban Res, right? I'm the founder of Easy Solution Tax and Consulting Services. That's my side hustle or my side gig, however you want to put it. And again, I'm the 2020 CBC Community Champion Award recipient. I got that award for my work around financial literacy. One thing that I didn't put on here, and I actually spoke to Michael about this just now, is that I'm also working on my CPA designation. And the reason why I didn't put that on this slide is because CPA is very strict about using the word CPA. So I don't want CPA to come after me to say, hey, how come you're advertising that you're a CPA when you're not? So they're very strict, and I try not to include that, but I'll tell people on the side that I'm a candidate for the Chartered Professional Accounting designation. All right.
So for one more time, before we get started, so what does CPA stand for those people who don't know that acronym? What does it stand for?
It's Chartered Professional Accountant. Chartered Professional Accountant, yeah, designation.
All right, okay.
All right, so week 5, I just want to shout out to everyone. I see a lot of familiar faces. I really applaud everyone for taking the time to participate on a Saturday. I know it is a big commitment, but it is an investment, and it's an important one. And for those joining for the first time, feel free to chime in. Feel free to ask any question. Maybe you heard something from the previous week and you wanted more information, or you want to clarify. Feel free to ask. We are here to help. If I can answer, there are tons of people who are participating. They will give great feedback. Last week we had some great suggestions from members of the audience. So feel free to ask questions at any time. All right, so as always, I like to do a quick review. So last week we talked about investment and investment in the stock market, right? We also talked about what is a broker or a broker account. So a broker is that person acting as the middle person between yourself, the buyer, and a potential seller, or vice versa, right? And in order to invest, we actually say that we talked about the fact that you need a brokerage account in order to invest. All right, we also talk about stocks, ETFs, and bonds. So stock is an investment. You are actually buying a piece of a company, and in return, you either get dividend or increase in the value of what you put in over that stock, over that investment. All right,
and
we talk
Andre,
about
just recap one more time. What is a dividend for those people who weren't with us last week?
Sure. So a dividend is a payout from the company. It's the company's way of saying thank you, right? So if you bought stocks in the company will give you a percentage of profit, and that percentage of profit is considered to be a dividend. So if you have 10 shares in a company and that company pays 10 cents per dividend, then you'd get what, $1? Hope my math is right. So you get $1 right there in dividend, right? So that is the payout that the company gives you as a thank you for investing, and a way of showing that the company is profitable, right? We also talk about ETF, which is exchange trading funds, and an ETF is a combination of different stocks or companies. And we also talk about the fact that ETFs is a way of hedging or minimizing risk, right? Because of the spread of all the different assets in that portfolio. And we're actually going to talk about portfolio in a second. We also talk about bonds. And just like Michael said, a bond is a fancy way of saying debt. It's a way of a company or the government categorizing money that they borrowed from investors, right? So that's another way in which you can invest in a company. And once you buy a bond in a company, the bond will usually pay interest, be it annually, semi-annually, or even monthly, whatever the terms are of that bond agreement. We also talked about investment strategies, right? Some of the strategies that we talked about include value investing, growth investing, momentum trade, or day trading. So these are strategies for different investors. And for value trading, we talk about buying stocks at a discount, right? So that's really it's the essence of a value investing. You're looking for those stocks that are underpriced in a high value company. And during March, when the COVID pandemic just came in North America and shut down the economy, there's a lot of value investment type opportunities that came about. We also talk about growth investing, which is you're looking for companies that are going to produce a high rate of growth over time. And usually you do a comparison of GDP, which is gross domestic product, which is the total output of a country within a given period of time. We also talked about momentum type trading. So this trading strategy is where you're looking for that stock that's really trending, right? So for example, in March and April, a lot of pharmaceutical stocks were trending because these companies were either talking about coming up with treatment for COVID-19, or they were talking about coming up with vaccines. And this made these stocks very popular. And so a lot of investors started buying those stocks, right? And it also generated what they call FOMO, which is fear of missing out. So a lot of people will see a stock price rising, or a company announce a certain product or service, and they don't want to miss out on that opportunity. So it creates FOMO in the market, which generally drives the price upward. Then we also talk about day trading, and day trading really is buying and selling stock the same day, right? And some people do day trading as a living. The good thing is that if you are classified as a day trader, technically that's a business, so you can write off certain expenses from any profits you make trading. So for example, your internet, your cable, your cell phone, your computer, all of those would potentially be classified as business expenses if you were classified as a day trader. All right. Any question regarding the quick review before we go into today's content? All right. So I just want to make sure everyone is with me. I know you've been with me for 5 weeks, and by now you all are probably tired of me and don't want to see my face no more. So before I move on, I actually want to get some Irie in the house. Can I get some Irie from everybody?
All right, we're coming in.
All right,
Irie.
All right, there we go.
From Cam, from Mona. Lalita.
Everybody Irie. Listen to me.
Irie this morning.
If I check the slide in the next couple of minutes and everybody in the Irie, I'm gonna tell everybody to go get some coffee and join me back, because I need everybody to be Irie.
All right. And obviously Blue Mountain or Ethiopian coffee.
Blue Mountain.
All
right. So before we actually go into the discussion, here is our trivia question. So we had tons of participation in the previous session, and so this week we want more participation. Please, if you can, come on the microphone and speak up and speak out. Say it loud, right? From our previous session, please tell me, what are the 2 ways to earn income from investing in a stock?
Want to say that question?
Oh, somebody said mint tea. Listen, my son actually loves mint tea.
Dividends and capital gains.
All right, there we go. So Amanda says dividends and capital gain. Perfect. Amanda, can you tell us what is a dividend and what is capital gain?
Okay, so a dividend is, like you said, it's a portion that the company will pay you to hold their stock, like a thank you. And then a capital gain is just the appreciation in value over what you paid.
Awesome.
Is that right?
Probably. Awesome. Yeah, that's terrific. Terrific. Shout out to Amanda. So Amanda is all the way in Ottawa. Beautiful city. Thank you. All right. All right. So again, we're continuing with the module Investing and Banking Fundamentals. And actually, I just found this Jamaican proverb fitting for today's discussion. Puss and dog no have the same luck. So I don't know if everybody know what that means. But really, it's talking about some people being more favored, or I see I'm getting some reaction here. Some people born lucky, or some people have opportunities handed down or presented to them. But in life, not everyone has that opportunity. And so therefore, we need to make decisions now that will benefit us in the long term. We also actually need to find ways to manage risk, right? Because, just like Michael said, he wouldn't go to Jamaica during this time because of fear. Well, I say I go to Jamaica because I'm YOLO. All right, I'll get carried away. I digress.
And we all know what YOLO means. For some of the people over 30, YOLO means you only live once.
Yeah.
So YOLO, YOLO.
All right. All right. So just a quick disclaimer because we are talking about investing. So I highlighted this last session. This presentation is not, and nothing in it should be construed as an offer, invitation, or recommendation in respect of a company's credit facilities or any of the company's security, or an offer, invitation, or recommendation to sell, or solicitation of an offer to buy the facilities or any of a company's securities in any jurisdiction. Neither this presentation nor anything in it shall form the basis of a contract or commitment. This presentation is not intended to be relied upon as advice to investors or potential investors and does not take into account the investment objectives, financial situation, or needs of any investor. All investors should consider such factors in consultation with a professional advisor of their choosing when deciding if an investment is appropriate. By participating in this session, attendees agree to indemnify and hold harmless Andre Smith, Flip and Floss, aka Flip and Floss, Easy Solution Tax and Consulting Services, the BBPA, Urban Res, and its partners of any and all liabilities or legal proceedings. All right, so if you agree, let's get it started. All right, so bear with me, guys. So as of last week, I started putting in these cheesy accounting jokes. So if you don't find them funny, that's fine, right? But the one I found for you today, why don't skunks have to pay taxes? Right? All right, so the answer is because they only have 1 cent. All right, so by the end of this session, you should know what is portfolio diversification and how to diversify asset by class, how to develop a portfolio based on a risk tolerance, and know the different categories of risk management. So there might be some new words here for people. So I'm gonna actually go through some of these words. It's important that as a community, we actually understand these languages so that we can make better financial choices, right? So a portfolio is essentially a combination of all the assets that you own. So what do I mean? So let's say you have a house and you have $500 in cash in the bank, and let's say you have a cottage. So that would be your portfolio. Those are all the assets within your portfolio. If you only have a car and a pair of expensive bag and a pair of expensive shoes, then those are maybe your asset in your portfolio. I don't know if they have any resale value, but those would be your assets, quote unquote, right? Now, diversification is a big and fancy word, which really means having different types of assets in that portfolio. So for example, if you only have one house, right, then that is not a diversified portfolio, and that might create a risky situation. For example, if there's theft or if there's fire and your house is damaged, then you'll essentially lose all of your savings or investment. So diversification helps to minimize those risks, to have different asset class or different pool of asset to minimize risk. So that's really what it is. So that's what portfolio diversification is. It's what you own and the amount of things you own that creates diversification. And this is actually one of the most fundamental yet important concepts in finance, right? So how to develop a portfolio based on risk tolerance. So we talk about a portfolio, and risk tolerance is really saying how much of a risk you are willing to take. I will tell you this, 9 out of 10 times I talk to somebody from the community about investing, me not invest because me hear say Mary invest and she lose everything. That's usually the response, right? Translated to English, I'm not investing because I know someone by the name of Mary who invested and lost all her money. So everybody always knows somebody who invested and lose everything. Well, that's because they didn't diversify, and perhaps they didn't know their risk tolerance or how risky the investment was before getting into it, right? So we also want to know the different categories of risk management, right? So risk management is knowing our risk tolerance and finding ways to manage those risks. And by manage, I mean minimize or eliminate, right? I mean, it's hard to eliminate risk, but we can essentially minimize risk as close to zero as possible. And so we're going to talk about some of those things as we walk through today's presentation.
And I think just if I could just add on that risk piece, Andre,
Sure.
everything in life that we do, whenever we take a chance or do something different, is a risk. But we've got to weigh that risk, and we've got to know the risk that we're taking. And I think it's very important, obviously, as people of color also, or as Black people for this purpose, to understand we have to understand the risk as much as possible that we're taking when we're making choices, so that we're not making risks that are going to jeopardize our well-being or our health or our safety. So definitely risk management
100%.
is something we always have to consider.
100%. And even when we talked about, thank you for that, Roderick. Even a lot of people will say they don't take on risks. But I'm gonna ask you one question, and it's actually gonna change your perception of risk. Did you know that having one source of income is extremely risky? The fact that you only have one job and one source of income, or even if you have two jobs, it's the same type of income. That's inherently very risky. And COVID-19 taught us that this year, because a lot of people got laid off, right? So even though you're saying that you're not taking on risk because you don't want to invest, you are taking on risk by having one source of income. I know it's not easy for people to build multiple sources, but just keep that in mind as we talk about risk. And I actually want to show you somebody, one thing I love about cartoons is that they actually depict a lot of real life scenario. And I actually like to watch SpongeBob. I hope nobody judge me. I like to watch SpongeBob because a lot of the things that come in SpongeBob talks about business and risk and investing and all of that good stuff. But you probably won't easily pick up on it, but I have a video here about Mr. Krabs. Can you hear? Can everybody hear the video?
No.
I wonder why it's not, it hasn't been playing since the...
Maybe the volume isn't up.
The volume, it's up on my end. It's showing max volume.
Something there.
Mhm.
This is weird. All right, give me a second.
Can't hear that there.
I think it's on pause. When you saw on the thing a bit, there's that little pause thing.
You can't hear it now?
No, we can't hear it yet.
All right, hold on.
I think it may be, maybe we could check the volume from your computer.
The volume from my computer is up.
Okay.
I don't know what's causing the...
I can hear fine.
You can hear the video?
Yes.
Oh.
Well, I can hear you fine.
Yeah, we can hear you fine, but we
But
can't.
not the video.
No.
No.
It might just be like presentation to output settings. I'm not sure how to fix it, but I think that...
We'll have, you know what? I think we probably just run that for next week then, my brother.
Okay.
We hear it.
You can hear it now?
Yeah.
All right. Good stuff. I'm actually glad.
Loud and clear.
Too loud, too loud.
It's too loud, all right.
Determined to save money, I swear that's what I heard.
Zeros, francs, pounds, credit cards, lay up, down. Charge it, max it out. Here's our life savings.
I've landed in money nirvana.
Never ending bank account. I'm good. You good, we good. Getting this money just like we should. And they wish they could. Let's get it understood.
How much money we talking about?
1s, 5s, 10s, 20s, 50s, 100s. Keep them coming. Thousands, millions, billions, trillions, and up to
Where is success? Money.
Gotta make that money. Don't never let them come try to take that money. Make so much money that they hate that money. Have left to the bank, but it ain't that.
That's practically giving money away.
So, anyone who knows...
I just made more money than I know what to do with.
Anyone who knows Mr. Krabs, snap. You know that Mr. Krabs love money, right? Mr. Krabs is always about money. So who can tell me what's wrong with that scenario? Why is that risky? Why is Mr. Krabs and if you heard the other two guys in the background, oh, this is all my life savings in cash, right? who wanna chime in and tell me why those two guys with their life savings, why is that risky? And why is Mr. Krabs' behavior around money so risky?
Hi, Andre. Hi, everyone.
Hi.
Definitely for the guys with the cash, I think like cash can devalue. So having all your assets in cash, I think is really risky. So that's what I would say about that part.
100%. I completely agree. So right there, Mr. Krabs, along with those two guys, they have their cash. Well, Mr. Krabs keeps his money in his safe in the Krusty Krab, and I don't know where those two guys keep their money, but it's in cash. And we talked about inflation, right? So they're losing money because of inflation, but also too, all their earnings or all their assets is tied up in cash. There's no diversification, right? So when I actually watch SpongeBob, I look for things like these. You can call me crazy or weird, I know, but I actually look for these scenarios because they tell a story, right? And so that's really what we are talking about when we talk about portfolio diversification, right? Diversification is a risk management strategy that mixes a wide variety of investment within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicle, right? So an investment vehicle is really something that you invest in, really. So for example, a stock or a TFSA or whatever the case may be, attempting at limiting exposure to a single asset risk, right? So whenever you watch the news or if you hear anybody talk again, or if somebody come to you and say, hey, don't invest because it's risky, well, you can say, well, I remember when I took that financial literacy class and the guy spoke about portfolio diversification, which is the management of risk. And you can say it very intelligently, you know, just to make you sound smart and know what you're doing. But really, we can manage those risks effectively. And so that's what we're going to talk about. So here I've come up with some example as to how we can diversify by asset class. So by now, everyone should know what a stock is, right? So we can do some investment in stock, right? And in future slides, I'm actually going to walk you through different portfolio type based on personality, right? So we can buy some shares or equity in a publicly traded company. So that's one source, right? And by doing so, we can potentially earn two types of income. We can earn dividend and we can earn capital gains. So right there and then we've solved several issues, right? We have a job. Now we diversify income stream, but we've also created two additional income stream potentially, dividend as well as capital gain by just one investment.
Hey, Andre.
Yep.
And it was one of the things I found interesting in that little cartoon. He said, I have more money than I know what to do with. Right?
Yeah.
And, you know, I think a lot of times in our community, not for everybody, thank God,
right,
but when people in our community get money because they haven't had this financial literacy, often they don't know what to do with their money. So,
True.
you know, they'll buy jewelry, they'll buy cars and things that depreciate. And, you know, I guess just to show that they have money.
Right.
But then in the long run, that usually doesn't last that long. So I think what we're talking about right now in terms of diversifying that portfolio and how to work with your money is extremely important. So everybody
100%.
listening very carefully to this.
Yeah, no, good point. And, you know, we're not saying that you can't live the good life. You can live the good life, but you actually want to have a plan and you want to be strategic about how you live the good life. You can't get up every day and live in the good life. And then tomorrow, you know, by the next following week, you don't even know how you're going to go to university. You don't know how your kid's going to eat. You don't have any wealth or anything to pass on to the next generation. So, I mean, it's a balance, right? You want to make sure that you're doing the things that you enjoy, whatever that is. For me personally, I like to travel, but it's not so much about travel to post on the gram, because if you go on my gram, a lot of the trips that I take, I don't post them, but I travel to indulge in the culture. I don't go to resorts when I travel. I travel and I stay near to the local so that I can bond and mix with people and learn and grow. Right? So whatever it is that you do, keep doing it, but have a plan in place to build multiple income stream and to live comfortably. So that's really what all of this is about, right?
And you mentioned one quick word was wealth, mm-hmm. right?
Well,
so
100%.
There's a difference between wealth and having money, right? Let's talk about that just real quickly so that people can understand. Right now, we're talking about building wealth, and not just wealth for ourselves, but intergenerational wealth. You want to just talk about the differentiation between wealth
Of course. I mean, simple put, just having money. I think people who have money tend to worry a lot about money, right? So having money means that you're able to do your day-to-day things. But having wealth is you really don't have to worry about money, and there's enough to pass on from generation to generation. How I think about wealth is having enough assets, and not so much money as in the physical cash, but having enough assets that can be passed on to your kids' kids. Once you reach that point where your son or daughter, their kids are okay financially, that's wealth, in my opinion, right? And what does that mean? That means they have a house to live in. They have enough money to pay for college or university. They have enough money to start a business if they want to. But there is asset being passed on to them, and different types of assets. So not only just cash, because one of the things I learned about cash is that cash is king, right? So them say money make the world go round. But cash is also the most liquid asset, meaning that it goes away quickly. So if it is that you pass on $500,000 to kids who don't really have a financial literate background, I'll tell you that they'll blow up that 500,000 in a matter of minutes, right?
And then
Sorry, let me just chime in for a second. Well, good morning, everyone. So wealth is defined as how long you can sustain your existing lifestyle without any additional income coming in. So hypothetically, if you lose your job, and there's a great book you guys should read called The Millionaire Next Door. And it talks about, gives you several examples, but one of them that sticks out in my mind is a couple, I believe in Midwestern America, who have a household income at the time, this is many years ago, had a household income of $70,000 and were able to sustain their lifestyle in terms of expenses, social interests, travel, et cetera, for 7 years without any additional income coming in. So that's one of the measures they use to define wealth, not from necessarily an intergenerational standpoint, but it's safe to assume that if you can sustain your lifestyle for 7 years without additional income, then you probably have enough of a sustainable financial portfolio that your next generation can benefit from. The other thing, just going back quickly to what you mentioned, Rod, about the aspects of what I call deferred gratification. A lot of our young people and present day people, based on media and marketing, we're sent a message daily that we have to have it now. Thanksgiving, right. Black Friday sale now. Christmas, get your deals now. And what we do is we lose our sense of deferred gratification, meaning the willingness and ability to wait for something, to consume it or purchase it at the right time relative to the circumstance. So I have friends that played pro football in the NFL and so forth. I have one friend in particular, or acquaintance, I'll call him. Anyway, the issue is he was given a $600,000 signing bonus. He was 21 years old at the time, and he blew that in one weekend. $600,000, and worst part is he got injured 3 months later. So guess what? Career's done, extremely deeply in debt, and no way to replace that income because of what, especially with the NFL at the time, that didn't have the same sort of protections for its players at the time as it does now. So the important thing to remember, folks, as Rod said, the jewelry, the cars, the thing, those are immediate gratificational items that people go out and purchase. Deferred gratification is when you have a plan.
Right.
And I think just one last thing before we run.
It's a big topic.
Very important as Black people concentrate on wealth. You know, I was watching something this morning, and there was a gentleman who was talking to a white journalist and talking about how wealth, because of our labor. If you think about the Caribbean, you think about North America, you know, we as Black people, in most cases, help build this wealth for somebody else. Yeah. And as a result, now they've got intergenerational wealth, you know, the banks, you know, the plantations, and, you know, all the major industries that we've helped to design based on our labor, free labor at that, was wealth driven for these individuals. Now ourselves, having now started to attain and understand some of these philosophies of money, have to now start building wealth for our future generations.
Absolutely.
So for a lot of cases, we are the first generation who understands this, because I mean, even when it comes to our parents, you know, we didn't have anything like this. You know, my parents didn't have any financial literacy that they could pass down to myself. You know, we watched and learned in a lot of cases, but there wasn't anything formal. So now we've got to take intentionally pay close attention to how we can earn, and not just money, but wealth, and have that again with our legacy. Thank you very much, Andre.
Yeah, no problem. Good discussion. I really like the conversation that we're having. And yeah, like as you're thinking about building wealth, just like Farley said, that guy who got the $650,000 blew it up in no time, right? The first thing, you need a plan. If you get a large sum of money, whether you win the lotto or anything, you need to devise a plan of how you're going to spend that money, right? Whether you're going to buy stocks, bonds, real estate, or a combination of all the above, right? So you actually want to use that money to make more money, right? Remember, we talked about interest, dividend, and compound, right? If you know what compound is, you earn it. That 650,000 compounded by several years at a certain interest rate could potentially become $10 million, $20 million over a period of time, right? So we have to know how to build, sustain, and transfer wealth. Those are very key. So it's not only about building wealth, because what I find I see happen with a lot of people, included in the Black communities, that we may own 1 or 2 houses, but we never create a will. So now you have kids fighting over assets or going through probate court just to get possession. So we have to build, sustain, and be able to transfer wealth. The transfer is key, right? So, and that transferring of wealth usually comes in the form of a will, which we're going to talk about in future topics, right?
Andre,
yep.
Before you leave the topic, Andre, I just want to add one word each based on what Roderick said and Farley. If you were to just look up the dictionary meaning, and we could have a long discussion on this later, but just look up the dictionary meaning for rich. It's amusing and lush.
Exactly.
And what's the dictionary meaning for wealth? Prosperity. Right. So one is kind of like here and now, and you do what you want, and one is long-term sustainable. One word.
This is a short-term mindset.
Yes, wealth is prosperity.
Right.
And it involves, as we're talking about, investments, making your investment work for you beyond. It's the synergy of starting with 1, and that 1 becomes 1.5, and then 1.7. Continuing after you make that first stuff, as against the expense of buying a luxury car or buying a luxury home, and it's a here and now. Exactly. So one is lush and amusement, musing, and one is, so wealth is prosperity.
Yeah.
The other thing I'd like to say, 2 things actually regarding this program. And I hope the audience and the folks participating appreciate this. A couple of things I want to say. A, when we spend a little more time on anything, that emphatic sort of tonality that you're hearing from the facilitators, it should be, you should internalize it at how important the topic is, right? So Rod's chiming in, Michael's chiming in, Andre obviously is doing his thing, and myself. But the importance here is when we break away from sort of the timeline of the program, that's because this is a deeply important issue as it relates to all Black people who are, especially Black people who have been oppressed, right? And we have to understand that we are the products of oppressed culture. So when our parents from the Caribbean or wherever we may be from don't share information with us about things like wealth and financial literacy, either they lost it as a result of the transatlantic slave trade and then could not pass it on, or it's taboo, or it's almost like, whoa, wait, this is big people conversation. All those old school things come out of oppressed culture, folks. We have to understand that. And the only way we will move forward as a people is to get that oppression, emancipate ourselves from mental slavery. None but ourselves will free our minds. Remember that. It's critical.
100%.
So when we spend this time with this amount of emphasis, I hope everyone's internalizing the deep level of importance that these topics drive us to talk about, and have everybody chiming in so emphatically, as I said earlier. That's the, and I'm looking at, we put out a challenge in the beginning, and this dovetails back to the program in general. we need you guys to invite somebody to join this session next week. The numbers need to grow, right? Because here's the thing with knowledge. When you share it, it multiplies. It's not like a cookie when your mom says, give your sibling a piece of your cookie and you end up with half. Knowledge multiplies when you share it. Our numbers need to grow here so that we're creating a critical mass of literate, financially literate Black people so that we move forward. Very, very important, folks. I had to say that because I was as you guys know, I came on a little late today, but I was looking at the numbers saying, oh, I wonder how many people we have today. We have to be more emphatic about caring about our neighbor.
Yeah.
Right? Because if we get the knowledge and we're not sharing it and we're not seeing the numbers grow on a weekly basis, so we're going to put out a challenge for a hoodie. Rod's got crazy hoodies at the crib, right? We're going to put out a challenge. If you bring a friend next week and double the numbers, right, we'll reward you guys for that effort because there's no way we can do this on our own. No way.
So right now, I'm going to put out that challenge, dovetail what Farley said. If you're going to bring a friend next week and you let us know in the chat room that you're going to bring a friend, you bring that friend next week and they say, hey, this person brought me, we will send you that hoodie next week, 1,000%. Guaranteed. So put that in that room.
Those who bring a friend this week, because we asked that question last week.
Yeah.
Okay.
Those who brought a friend this week.
Well, the numbers aren't showing that a friend was brought. That's my concern.
Well, we're at 53.5. We did about 40 last week. So we've got 13 more online. So someone may have brought a friend.
Okay, I get you. I get you.
Yeah.
So as we're on that topic, we're talking about rich and wealthy. I actually, as I start to develop my program that's geared toward the Black community, I tend to do a lot of Google search and research. And one of the things I did was I wanted to see how like who is featured when we do certain searches. And I did a search between wealthy and poverty or rich and poor. And so when I search poverty and I go to the images, this is immediately what I see, right? And then if you actually go do a search of wealthy, you can see the difference, right? Who is highlighted as wealthy, who is shown as a success story, right?
And in the work that we do, folks, perception is everything. And as you just saw what Andre shared, everybody in terms of poverty was a person of color. I saw more Black folks there than I see in Scarborough on a daily basis, right? And when you saw wealth, there was nobody of color, right? So perception often taints our beliefs, right? So we've got to rewrite this narrative.
We have to rewrite it.
Absolutely.
And that's why this is why what we're doing right now is so important, right? You got to bring somebody else. Knowledge gain and not passed on is no knowledge at all. We have to transfer this knowledge to the community, right? And someone asked about foreign diversification. So if it is possible to buy a house in Jamaica. So what I'll tell you that from my experience, because I'm actually going through that process of trying to acquire a property in Jamaica, is that you will need what's it called, a TRN number, right? So you'll need to get a TRN number. I don't know if you can get it if you're not a citizen. That's something that you'd have to look into. I'm a citizen, so I had it before I moved to Canada. But you will need a TRN number. You cannot complete the process without the TRN number. And the TRN number is the taxpayer registration number, and it works the same as your social insurance number. And then really, you just reach out to one of the banks in Jamaica, and you get a mortgage pre-approval. The process, from what I know, there is it's somewhat easier than the process here, but it's more expensive in terms of startup costs that you'll need to actually buy a property, right? But that's another way that you can actually diversify by owning either being all of these classes, stocks, bonds, real estate in other countries or other regions in Canada, right? So that you're, again, managing that risk appropriately. All right, so just going to talk about, we've been talking about these already, but some of the pros and the cons of portfolio diversification. So actually, one of the things that CPA, my program, Chartered Professional Accountant, does a really good job at is helping me to make decisions between two or more alternatives. And every time I'm faced with a decision, I like to talk about the pros and the cons. And I look at numerical pros and cons as well as qualitative pros and cons. But this is something that I'll tell you to get in the habit of doing when you're making decisions. You want to just write down all the risk and the rewards, if you want to call it that, when it comes to investing, right? So when you talk about portfolio diversification, what are some of the pros? So it reduces portfolio risk. And again, a portfolio is really a collection of all the assets that you own, right? And the risk is the possibility that you might lose some or all of that investment, right? So it reduces that risk. That's one of the pros of diversifying. And I've seen that even with my investment in the stock market, because I've bought in different countries and different sectors, some stocks might be going up today and others might be going down, and it has like an offsetting effect on my overall portfolio, right? So it's really good. Hedges against market volatility. So hedging is really a nice word of saying it protects against market movement in the market, up and down movement. So one of the things that you'll find, especially in the stock market, is that there's a lot of price movement, prices going up or down constantly. So by diversifying your portfolio, it kind of manages that movement. Just like I said earlier, with my portfolio, because it's diversified, if some stocks are going up and others are coming down, it kind of have an offsetting effect, right? Another positive of diversification, it offers high return in the long run. So it's more of a long run strategy, right? That diversification achieves. So by diversifying today and building multiple streams of income, that will provide returns in the long run. So for example, let's say you bought 2 houses, one in Canada, one in Jamaica, right? Up front, it will cost you a lot of money to invest in these properties, and it's gonna take some time to find tenants. And maybe over time, you probably have to put some money in that property to pay for the mortgage. But once those mortgages are paid off, that house, the total value becomes something you own, as well as any rental income coming in. So almost 100%, I mean, once you take out all the business expenses, almost 100% of that income will be yours. So it is something, it's a more of a long-term strategy. With that said, it can still be used in the short term. I've used diversification in the short term as well, right? This could be in the form of a short-term ETF that we talked about earlier, an exchange traded fund. If you're buying and holding it for 3 months or 6 months, whatever the case may be, you can achieve diversification in the short run as well. What are some of the consequences or the cons? So it limits gain in the short term, right? That's because you are more focusing on diversifying. So what is happening is that you are taking your money and you're spreading it over different asset class. So that kind of minimizes the gain. Or, if it was a case where you took all the money and you put it in one stock, for example, the chance that you would make more money would be far greater, but so is the loss, right? So that's what this means here. Because you're taking that money and spreading it out, it limits the gain in the short term because of that spread, right? It's time consuming to manage. So the more you start to diversify, the bigger your portfolio gets, because you start owning more things, right? Now you have 3 properties or 4 properties. Then you have probably 200,000 or $1 million in stocks. Then you have multiple small businesses. So it becomes more and more time consuming and more difficult to manage as you start diversifying. But you can hire people. You can hire people easily to manage those portfolio for you, right? So there are ways you can actually work around that con there. The other thing is that it incurs more transaction fees, right? So because you are buying more things, there's going to be more costs. So if you were to just buy one house, then you'd pay one closing cost. But the fact that you're buying multiple houses, you have to pay those closing costs on all those houses. The same with the stock. Because you're buying different types of stock and investing in different companies, you have to pay a different commission each time you buy those stocks. So you're going to incur more costs, right? Again, those are short-term costs that will be offset in the long run from any potential returns. All right? Any question regarding the pros and cons of diversification? Again, this is an extremely important topic. If you do a Google search right now, you will actually see a lot of conversation and videos about portfolio diversification. Off the surface, it just looks like just buying a bunch of things. No, it's not just buying a bunch of things. You actually have to be strategic. You have to plan, you have to form goals and things that you need to accomplish in the long run as part of your diversification strategy. So I'll take a couple questions here before I move on.
All right, I got one quick question for you. You said that you can use the diversity as a short term. What example can you give as a short term diversification portfolio per se?
Yeah, so in like a good question. So like I said earlier, so an ETF. So if you're just buying an ETF for the short run, because the ETF itself is a diversified asset, meaning there are multiple stocks in the one asset class, it achieves diversification. So you might be buying that ETF for a short term, maybe 3 months or 6 months to make a quick gain and out. Or if you're doing like a momentum type trade, rather than investing in one stock. So let's say there is a pharmaceutical that's trending, but there might also be tech stocks that's trending. So rather than dumping all that money in that pharmaceutical stock as a swing trade, you can potentially buy some pharmaceutical as well as buy some tech stocks, right? 2 different sectors potentially minimizing the risk, potentially, right? But I will tell you, it's more of a long-term strategy. Even though you can achieve it in the short run, portfolio diversification works best in the long run. All right, Yvonne says, may I add that you should mention that there are sometimes opportunities to invest in stocks as an employee, that is. Some larger companies offer investment as part of their employee benefit. Really good point. Thanks, Yvonne. That's extremely important. So yes, some companies will compensate you through what they call a stock option benefit.
Yeah.
Right? It's extremely important. Yvonne, did you want to talk about that?
No. Well, that's how I got started. I used to work with CIBC, and as part of the employee benefit was that for every dollar that I invested, they would match 2 times. So I bought stocks that way, and then from there, I cashed in some to buy my first property. Right, and then so on and so forth. So that's a good way of starting as well.
Yeah, 100%. Thanks, Yvonne. And the other thing that you want to keep in mind, and we're going to talk about this in future presentations, but keep in mind that capital gain in Canada is taxed more favorably. In some countries, there's no capital gains tax, right? So what do I mean by capital gains is taxed more favorably in Canada? So let's say you earn $100,000 as an employee, you're going to be taxed at your marginal rate, meaning the rate that you have to pay the government your taxes at, right? So the average marginal rate, I think, is between 30 and let's say 50%. So if you earn 100,000, you can expect to pay about 50% in taxes on that 100,000. Whereas if you earn the same 100,000 through investing, you're going to pay tax on 1/2. Yeah. So only $50,000 of that 100,000 you're gonna pay tax at your marginal rate. So right there and then, 50,000 is tax exempt, right? So capital gains is taxed more favorably. In some countries, there's no capital gains tax. I think Jamaica, I don't know if they have like a capital gains tax. I know they have tax overall and everything, but I don't know that there's a capital gains tax itself, right? So this might be exempt income in some countries, which is why sometimes you watch the news and you hear that some companies pay 0 tax because they actually utilize a tax system in different countries and different methods to kind of work around the tax system. And then the fancy way of classifying it is called tax planning or tax avoidance. All right.
All right.
No, Andrew, I wanted to throw in a trivia question here because I know we're talking about the risk and the portfolio and that sort of stuff. We're focusing on other capital means to grow wealth. And it just struck me, if someone could do the maths for me, if you're working, all you're getting is strictly labor, just your salaries and wages, how much you think you need to earn per hour working every day of the week for 24 hours a day for the full year to make $1 million? Just do the maths on that and get back to me. If you work every day, 24 hours a day, 52 weeks a year, or 24 hours a day for 365 days,
at what salary?
Would be your hourly rate?
Oh,
Yeah, your hourly rate. Hourly rate.
Hourly rate.
You want the hourly rate?
Hourly rate. to make $1 million?
All right, so we'll have somebody in the audience figure that out, and we can keep that moving. So that's a good question from our elder and our senior in terms of the accounting.
Yeah, the point I want to make is that we have to look other ways, because when you see the number, the question is, anyway, do the numbers so we can talk about it.
I'm done the math. I don't know if I'm right, but I'm done the math.
Oh, it's not you. You're ineligible for competition.
No, you're not included, but you can do it too. Working 24 hours a day for 365 days of the year, what would your rate be per hour to make $1 million?
And I want to throw in a little caveat there. The youngest person to answer is going to get a bigger prize.
Okay.
Good stuff.
And that's unrealistic, but I want to take it to the extreme.
Right.
And then for the more advanced folks who think they get the numbers, give me one that is more reasonable, where people only work the working days, no weekends, no stats day. What would that rate? What would that rate?
40 hours a week.
Yeah. That's a bonus question.
All right, so we'll wait for somebody to plug that in.
All right, the numbers are being crunched. I can see Jumar working hard to crunch the numbers there. Oh, somebody got it. Yep, Fabrice. Yep.
Perfect.
That's what I got as well.
Perfect. Right. So the question I want to ask, in our community, the normal average person, that is the extreme, working every single day.
Sorry.
Not even can do that. Who in our community make that an average, 114? And if you do the bonus question, that's the ridiculous one. Do the one where you only work weekdays for 8 hours a day, no stats day, and use about 13 stats day. So you're going to take out all the weekends, Saturdays and Sundays. You're going to take out the 13 stats days. Tell me what the rate would be.
All right.
On a lighter note, somebody said that they forgot to press send. That's like when back in the day, Michael, we know when people used to tell the teacher they did their homework, but the dog ate it.
Okay. I do this because there is a concept out there that rich is a millionaire. If you can make $1 million for the year, you can consider yourself rich. Not wealthy, just rich. Okay? Yeah. So how much of our people working like slaves every hour of the day for all days of the year, what would they make to make $1 million? $114. The average pay scale out there now is not $114 for the casual workers, probably for professionals and so on. What's the bonus answer, the bonus question answer?
We haven't got that one yet. $118.37.
No, that's not it.
Somebody got that one. All right, well, I think we should keep on moving.
It would be higher. It would be a lot higher than the 114, I would imagine.
$475.
Fewer hours.
Remember, we're taking hands.
You're breaking up, Michael. You're breaking up.
Yeah, you're breaking up.
104 days disappear. Oh, sorry. And part of the question is, you're working with realistic numbers now. There are 365 days in a normal year.
Michael.
104 for weekends, Saturdays and Sundays, and you're taking out 13 for. I'm going to put it in the chat.
All right. Let's keep it moving there, Andre.
All right. All right, good stuff. And so for those who do not know how we arrive at the first calculation, so I literally Google search the total amount of hours in the year, and I divide the 1 million by the amount of hours, which is 8760 to arrive at 114. And I think that's what everyone else did. So for those who don't know how we got the calculation. All right, so big stuff now. We're gonna talk about risk and return in more detail. So I mentioned it earlier, but when we as investors, we yep. Michael saying something?
No, keep on going.
Okay, so you always want to compare the risk and return, right? And they call it the risk reward trade-off, which you'll see in future slide. But again, so what is risk, right? So risk refers to the degree of uncertainty or potential financial loss inherent in an investment. So that's a mouthful right there, right? So when we talk about the degree of uncertainty, we're just saying we don't know what's going to happen. We don't know the outcome of a course of action, right? It's the same as you getting up and going to work today. You might make it to work, you might not. You might make it home, you might not, right? So there's risk inherent in everything that we do on a day-to-day basis. But when we talk about financial risk, we're talking about money or asset, right? Or time that could be lost from a decision. So we're talking about actual dollars here, dollars and cents, right? So that's really the difference. Risk is all around us every single day. When you take that flight to Dubai or to New York or wherever, you're taking on significant risk because you don't know what's going to happen with that airplane, right? But again, so we're talking about it in the dollar sense here, right? And so what I like to say is that risk is people who are not financially literate or don't have the financial intelligence usually make financial decisions at great risk. So the more you know, the less risky things tend to become because you will know what to do and what not to do in most cases to either manage those risks or avoid them altogether. I don't know if anyone here ever traveled to Florida. What's that thing called where they try to sell you
swampland? Swampland.
No, that's not the word I'm looking for. Where they try to get you to
timeshare.
Timeshare. There you go.
Oh,
right.
Timeshare.
I remember I was in Florida and the people they were pushing timeshare. Yo, buy timeshare. And when I asked, what was the interest rate? Because I'm always curious about interest rate. What was the interest rate? And here's the thing: you can only buy that timeshare through a mortgage. You can't buy cash. The interest rate was almost 40%. And I was like, what the hell? Who in their right mind gonna pay a 40% on a mortgage? You know what I mean? So the more you know, the more you glow.
Andre,
I just made that up.
I think another aspect of risk that we should acknowledge is not passing on the knowledge to your children.
Yeah.
Right? Again, the old school, I'm going to speak for the Caribbean, the old school Caribbean methodology where there's certain categories of knowledge for parents and certain categories of knowledge for children, right? But you have to pass on those understandings to the children, and that's how you could perpetuate and develop generational wealth.
Completely agree. Yeah, and what you're referring to is what my grandmother always said to me, because when my grandmother have money talk, she always said, Pitney must be seen and not be heard.
Right.
Go in the other room, big people are talk. So I never grew up knowing about money. And you're completely right. Right? I actually start with my son. He's just 16 months. And I talk to him about stocks. He doesn't understand, but I talk to him about it anyways.
You mean
right?
You think he doesn't understand?
All right. All right. Yeah, so we need to know so that we can manage those risks, right? And so right now we're going to talk about different types of portfolios. So even though there's risk inherent in certain investment decision, everyone has different risk tolerance. So not everybody's going to get up and say, you know what? I'm very knowledgeable about stocks and investing, so I'm going to be extremely risky, right? No, people have different risk tolerance. For me personally,
Andre,
Yep.
So, Andre, can you hear me now?
Yes, I can.
Right. So before you move on to the next topic, I think some folks have provided the answer to what is the normal if you're working 8 hours a day for the normal. And it's actually $504 and some cents.
Nice. So a few people got it.
$504 and some cents per hour on a normal condition to be rich, which means you make $1 million in the year. Ask yourself what profession provide that sort of income for salaries.
I can't think of any.
A profession that provides that kind of.
I've gone offline again. Well, you have, you have doctors, lawyers, and accountants, and engineers, and so on. And that's one of the reasons why another side of what we do here is to tell our kids, go into the professions as well.
Exactly.
It's not just basketball and the DJ. Become an accountant, become a doctor, become a lawyer, become an engineer. Get into the profession.
It goes back to risk, Michael, because the probability of success of becoming a professional basketball player or professional musician or professional actor, right? While those are all credible careers upon success, but the probability of achieving it is critical. I share with young men, especially all the time. There are 400,000 grade 9 boys playing for their high school basketball team. That means there's 1.6 million in all of high school in North America, and only 60 get drafted annually. So when you do the math, you may as well buy a lottery ticket.
Yeah.
Yep.
Yeah.
So true.
You have to be ready for that. You have to, have an objective assessment like anything else. Where do I stand? If I'm 15, 16 years old and my name's not already renowned as a future prospect, right? You got to say to yourself, what is my foundation from a probability standpoint as far as my education and my plan B or my alternative angle? That's where the diversification comes in your own lifestyle portfolio.
So Roy's saying here he's a lawyer and he doesn't make 500 per hour. I think that the higher you go up, or even if you have your own practice, because I know as a entry level, you probably won't make 500 per hour, but there are ways, and it goes back to that risk again. Are you willing to take that risk in your career to get to that $500 per hour?
Exactly.
Right?
Exactly.
All right.
You know, when I was working at a hospital in Toronto, and when I came to my wife and her mom, and I told them that I am leaving my position to go at my current employer, they told me, well, not my wife, but my wife's mom, she told me how risky it is, and that she knows so many people who started and didn't make it through the practicum, because the practicum was about 10 months in length. And I was extremely scared because I was like, here I am, I have this very comfortable job. I can get vacation whenever I want. I can almost do whatever I want. And now I'm faced with this job where I can potentially lose everything. And I still went ahead and I still go for it. And it paid off, right? It's that risk. It's that, just like the definition says, let's go back to the definition of risk. And this is what most people are afraid of, right? The uncertainty, right? The degree of uncertainty. We don't know, right? But we've all taken some kind of risk, just like I said. If you are an immigrant to Canada, you've taken on risk, right? Because you didn't know what would happen if you move here. You didn't know if things would work out the way you perceive it to be, right? When you go to school, you took on risk because you invested in that education and you didn't know if it would pay off in the form of a job or a business or whatever, right? It's that uncertainty that exists, but we can find ways to manage those uncertainty as we move along, right? And you know that the lawyer and the group are Roy, so I'm not bashing you or anything, but you probably think about how I like to talk about supplementing my income. So if my goal is $1 million per year, right, and I'm already bringing in 300 or 200 from my job, perhaps ask the question, how can I bring in extra 300? Is there a position in my company that I can go for, or can I do something on the side to supplement it, right? So you always want to think about how you can earn that extra income to get to that goal, if your current position is not paying it, right? So, and then we're going to go in the next segment. We're going to talk about portfolio risk, right, and the different types of risk. So we're going to talk about a conservative portfolio, right? So a conservative portfolio allocates a large percentage of total risk securities, total low risk securities such as fixed income and money securities. So this is where you're invested in things like GICs. So GIC is General Income Certificate. So it pays a fixed interest rate, right? It's very low risk. You put in a certain amount today and you let the bank keep it for a certain amount of time, and that's called a maturity. So if you put in $500 today and you hold it for 5 years, you get a certain interest rate for a period of time. So that's a fixed income security. So when you invest more heavily in that type of security versus equity, which is like stocks or ETFs, that is considered a more conservative portfolio. So you're a low risk, right? So here they kind of give you, if you're a low risk person, this kind of gives you a guideline as to how you can diversify your portfolio. So even though you're low risk, you can still achieve diversification and take on some level of risk. So here, 70 to 75% of your income is in fixed income security, which is low risk, right? The other 5 to 15% is in cash and cash equivalent. So a cash equivalent would be something that can easily convert to cash, right? So for example, a treasury bill, right? So the government sometimes give treasury notes so that people can buy these treasury notes and get a return on it. So that would be a 5 to 10%. So cash is cash. It's not going to change. It might lose value, but there's no risk to it other than inflation, right? And then there's equity. So you can put about 15 to 20% of your investment or your cash in equity. And that would achieve a conservative portfolio. So that's a low risk portfolio, right? So let's say you want to take on moderate risk. You're like, okay, I'm 28. Even if I fail, I can still recover. I have time or whatever. Then you start thinking about taking on some more risk. I'll tell you, that's my mindset. I am actually very risky when it comes on to investing. I don't know if I should be saying that proudly or I should be ashamed, but for me, it has worked and I've seen the return on my investment, right? So moderately conservative portfolio. A moderately conservative portfolio works for the investor who wishes to preserve most of the portfolio's total value, but is willing to take on some risk. So here you're slightly, right? You're not putting 2 feet in the water yet. You're just putting one, but you're dipping it a bit further, right? So rather than putting your big toe, this time you put your 5 toe them, and you say, all right, the water cold enough, right? So that's what you're doing here now. So you're putting about 35 to 40% in equity, right? And so you've reduced here the amount that you have in fixed income security. You haven't changed your cash remains the same, 5 to 10%, but you're taking on more stocks or ETF, all right? Anyone here anyone who's would describe themselves as a moderately conservative investor or conservative? Do we have any conservative investors here based on what I just talked about? All right, so it looked like everybody willing to dip more than them 5 toe into the water.
Yep. A conservative.
Yep.
You're conservative, Michael? All right, Mona Mona, are you conservative or moderately conservative?
Judith says
Judith is conservative.
Conservative.
Okay.
Fabrice is moderately conservative.
All right.
Still very young. That's a great
Very
thing.
young.
Okay.
All right, Fabrice. So maybe you want to put the 5 toe plus your big toe on the other foot. Since you say you're still young, you can take on a little bit more risk. All right. All right, moderately aggressive. So here we're putting more toes in the water now. And we're actually, so don't think you should put all 10 toes in the water. So remember, Warren Buffett says a smart investor never tests the ocean with 2 feet, right? So don't come say, Andre, slowly put the toe in the water and then you ultimately put all 10 toes. So just 9 toes, don't put the 10. All right, the 1 toe that should remain in cash. All right, so moderately conservative. So moderately aggressive model portfolios are often referred to as a balanced portfolio since the asset composition is divided almost equally between fixed income securities and equities. So let's break this down a bit. So this is where it's almost equal. So you're having 50% in fixed income. So for example, GIC, and then you're almost having about, 40% in fixed income and about 50 to 55% in equity. So you're putting a larger percentage in stocks, but you still have that diversification. So it's almost half and half, right? So it's just like those people like myself who go Tim Horton, but we say, oh, I don't like milk. I don't drink milk, but I prefer to drink half and half, right? So 50-50. You get half milk and half something else. I don't know what the next half are. But you get that half and half here through portfolio diversification, right? So you have that 50% fixed income, 50% equity, and the cash doesn't change. So if you take a look at this, you realize that cash is not changing. Can anybody tell me why cash is not changing? Only fixed income and equity.
Does anybody want to give that a shot? What's the question one more time, Andre?
Why is it that only fixed income and equity is changing? Why is it that cash is not changing so far in the example?
Right. Cam said cash won't gain interest.
It won't gain interest. Or, I mean, if it's in the bank, like what's the chance that you're gonna lose it? There's almost no risk, right? Because if you put $20 in the bank, then what's the chance that you're gonna? I mean, nowadays it's possible that you might lose it because the banks will tell you, oh, if you don't use your account for a certain period of time, then there's a no activity fee. So naturally there might be some risk, but that's really it though. There's no interest and very low risk. So we're shifting the composition of risk or the amount of risk. We're moving it from fixed income and we're putting it in more risky investment in the form of equity.
Roy said it's advisable to keep some cash on hand for emergencies or take advantage of other opportunities.
100%.
Okay.
And one of the biggest investor, Roy, again, Warren Buffett. So I actually use Warren Buffett a lot because he's actually one of my model investors. But he actually took out a good portion of cash, and that cash is on hand, right? To like swoop up any opportunity that comes, right? So yes, you want to have that cash on hand to be able to make those investment decisions, right? And so actually, I'll encourage on that note. So people should look up Warren Buffett. What's the Robert Smith? Anyone familiar with Robert Smith? Yeah. So people like Robert Smith. So those are people who are doing good things in the investment world, and they give a lot of advice. All right, let's see. All right, so now we're talking some more of my language, which is an aggressive portfolio, right? So aggressive portfolio mainly consists of equity and the value changes daily, right? High risk volatility. So if you look at it here, 50 to 55% is in equity. And you've also reduced significantly the amount that's in fixed income. So you have about 20 to 25%. The value changes daily, which is something, it's bittersweet for me because today I log in my account and I see X dollars. The next day I come in and I see negative X. Tomorrow I come in and I see half a X. The next day I come in, there's no X. So I'm like, what the hell is going on? I mean, it's a joyride for me, to be honest, but that's really what it is. There's constant changes because of price movement. So the share price is constantly going up and down. And so that causes the price to change. There's high risk and high volatility, especially if you're investing in one particular company, right? So if you're only investing in one company, that's significant risk because if that company goes bankrupt or if that company fails, all of your investment will be lost, right?
Andre, somebody just text or in the chat privately to me. If you could just explain what equity is one more time. What's an equity?
Of course. All right. So there are a couple ways that we can explain equity. So equity in the situation we're talking about now is in the form of stocks, right? So equity is a stock. So when you buy a stock in a company, it's equity, right? That ownership interest or that piece of the company that you own, it's called an equity, all right? But their equity can be looked at in another sense. So when you buy a house and that house gains value, so let's say you bought the house for $100 and now the house is worth, let's say $120. That $20 is considered equity, right? So those are a couple ways you can look at equity. But in this sense that we're talking about, we are talking about the ownership interest. So when you buy that stock, those stocks that you own, that's considered equity. All right.
Okay.
And that's kind of the definition, Andre. Equity is the ownership you have in whatever it is, as against debt.
Yeah.
My internet is unstable.
Yeah, so it's ownership in whatever. So even if it's stocks, if it's the house, whatever, it's that ownership.
Okay.
Yeah. So high risk, high volatility. So that volatility is talking about the movement, right? So the constant movement in the share price. So if you buy stocks, you'll see that certain stocks will go up and down quickly. Some of the stocks that are considered more volatile are what they consider penny stocks. So stocks that are traded for $5 or less, those are considered penny stocks. And so you'll find a lot of movement in those prices because people are doing what they call pump and dump, right? So pump and dump means that, so let's say whatever it is that caused that stock to be gaining some movement, people are putting a lot of money in it. And once the share price goes up to a certain amount, or they achieve their desired return, they dump it, they sell it off, right? So because of that constant pump and dump in certain stocks, you tend to have more volatility, more price movement. All right. All right. So now we're talking about a very, very risky portfolio, right? So now we've moved from an aggressive portfolio to a very aggressive. And based on my investment pattern in the stock market, this would be more reflective of my portfolio, being very risky. So about 80 to 100% in equity, right? And 0 to 10% in fixed income securities, and 0 to 10% in cash and cash equivalent. So this looks like my portfolio. The only thing you would see in my cash account is whatever I get paid in dividend, right? All my capital gains from short-term gains or from long-term gains, I reinvest those in equity. And reinvesting means I take the money that I make and I put it back either in the same stock or something else, right? And so because of that high risk, generally it comes with a higher return. Not all the time. It might come with a higher loss as well. So you have to know what you're doing.
But Andre, there's two aspects to that, because when you look at risk from a vertical integration standpoint, it's you might be taking a segment of your overall income and applying high risk to that. But you're not risking your mortgage, you're not risking your children's livelihood, etc. So, because when I see portfolio risk and being very aggressive, right? I'm in the music business as well, right? So I understand risk as it relates to investing in myself, literally, and in other people like artists, etc., where you're risking your overall livelihood, right? Right, which is different than risk taking 10% or 15 or whatever percent of your residual income and saying, I'm going to throw that into high risk stuff. So there's two aspects of risk.
There's two aspects, yep.
Yeah. So there's being risky with a segment of your safe income, if you will.
Right.
And then there's being risky with your overall, with
income.
You know, I mean, it's basically a crapshoot. It's a gamble.
That's a very important point, Farley. Thanks for bringing that up. So yeah, like Farley says, I wouldn't be taking my 100% of my income and be like, yo, I'm going to be very risky with it because I have other obligations. Exactly. So it's that percentage that you've committed to the stock market or whatever it is. Or you're not going to take your house and be like, oh, so I was reading one time where this woman, she commented on a post where she literally mortgaged her house to buy one share of Berkshire, the Berkshire company that's owned by Warren Buffett. I'll show you the share price right now. So the share price is actually, I think it's about 200 or 300,000 per share. So she literally mortgaged her entire house to buy one share in this company. $286,000 US. So that's Warren Buffett's company.
Well, yeah. Well, you look at, to give you another music business example, Celine Dion's husband mortgaged his house for her career. Right?
True.
Yeah. Right.
Now they're about roughly about approaching $1 billion in wealth.
Yeah.
Oh.
As a family.
Wow.
That's pretty good.
So
yeah,
risky.
Yeah.
So
you have to decide.
You got a sore throat on the wrong day.
Yeah, you have to decide and listen, not from your gross income. So I talked about this earlier.
Yes.
I plan around my residual income or my disposable income, right? What I have left after those taxes, right? So if you say that, okay, every month I'm gonna take 10% of that disposable income and invest it, and I'm gonna be very risky, then even though you're taking on risk, you're only taking on 10% risk, right? So good point right there. And so yeah, this would be my portfolio. Again, knowing what, even though I'm taking on 80% risk here, or I'm being 80% to 100% aggressive, I can achieve some form of diversification here because I can still buy, for example, I can buy a few companies that are relatively stable and safe, right? So there are some tech companies or some big, what they call large cap companies, meaning they have 10 billion or more in market share. I can buy some of those companies, and I can buy retail, I can buy pharmaceutical, I can buy healthcare, I can buy government services. So even though I have 100% in equity, I am still achieving some type of diversification within that portfolio of equity, right? So when you think again about diversification, just think about getting different things, right? Different assets, right? And we want to stress that. We want to stress that so people know and understand the difference between asset and things, right? When you talk about a brand name piece of clothing or a brand name piece of item, in my view, that's a thing. That's some, well, I mean, everything is a thing, but you get what I'm saying. You're going to dispose of it. It's not going to gain any value, right? We're talking about asset here, right? And even if you're not able, which you should invite somebody else. I want you to start talking to your family members about the difference. Talk about asset, right? I read a lot of personal financial posts. I listen to a lot of blogs, and majority of the time, I would say 8 times out of 10, these are white people talking about asset and investing and how their parents pass on this information to them from a very early age. And so we are doing that. And for people who already know, kudos, great. But we are here for people who don't know, and we are going to help them to understand, and we're going to help their kids to understand. So that's really what the BBPA is achieving here through this session, right? So I'm really loving the discussion.
All right.
All right, so somebody have a nice synopsis here. Anything you wear on your ass is not an asset.
Love that one, love that.
All right. All right, so now we're going to look at categories of risk, right? So there are 2 types of risk, like major categories, right? So one of those categories is what they call a systemic risk. So this is associated with the market. This affects the overall market of the security. It is unpredictable and undiversifiable. However, the risk can be mitigated through hedging. Who can give me an example of this type of risk? All right, and I need a microphone answer for this one. I think everybody here knows the answer to this type of risk.
What's the question one more time, my brother, so people can hear it?
All right, so I need an example of a systemic risk. So a systemic risk is associated with the market. This risk affects the overall market of the security. It is unpredictable and undiversifiable. However, the risk can be mitigated through hedging.
And for those who don't know what mitigated means, it means lowered.
Lower, right.
Right? You're lowering the risk. You're mitigating a risk when you lower the risk, minimizing the risk.
COVID-19 impact.
All right, perfect. And that's what I was looking for, COVID-19. So there's no way. So look at the definition here. It affects the overall market. Did COVID-19 affect the overall market? Yes. It is unpredictable. Was it unpredictable? Yes. And it is undiversifiable. Is it undiversifiable? Unless somebody's gonna say, no, maybe you have COVID-19 plus and COVID-19 low version or COVID-19 I can plan for, but it is undiversifiable. So yes, it is systematic. It affects the entire market. So those are the type of risks that we can change the course of those risks. However, we can mitigate them just like Roderick says. We can do things to manage those risks. So remember earlier I talked about you can either take out all your investment from the market, right? So liquidate, sell all those stocks and take your money, hold your money until the volatility ends. So that's one way you can manage those risks. Or you can look for opportunities through what I call it hedging. So maybe you can buy pharmaceutical because certain pharmaceutical companies are doing really well. They're benefiting from the pandemic. So you can look for other industries or sectors to invest in, right? So that's how you can manage that risk. So even though it's unpredictable, it's uncontrollable, you can't change its course, you can do things to minimize that risk.
Andre,
right?
One quick thing there. From a diversification standpoint as it relates to COVID-19, it had different levels or rates of impact on certain communities, ours being one of them, right? The main one. So what we should look at from that perspective in terms of the overall objective of this course is that if COVID-19 is impacting impoverished people, right, which are unfortunately are co-located with Black people in this hemisphere, right?
Yep.
We have to say to ourselves, if we're going to try and mitigate risk against COVID or any future pandemics, right, our financial literacy is actually a way of mitigating the impact COVID will have on our, or something like COVID would have on our children. Because then we're not living in high density, lower income neighborhoods where the just social literacy itself accompanied by financial illiteracy, right, won't cause a greater issue. So we can in fact impact the impact that COVID-19 has had on us as a people.
Yeah, 100%. And you know, even from a business level as well, we need to do the same thing because you know, I actually ask a lot of people who own business, do you forecast? Do you even know what forecasting is? Do you know what prediction is, right? You know, so a lot of businesses, especially within our community, they get affected by certain events, and they don't have like things in place to manage those risks or to like a preparedness strategy, for lack of a better word, so for when something comes. So when we talk about financial literacy, and that's a good point, Farley, we have to talk about it on the individual level, and we have to talk about it at the family level, as well as on the business level, right? Because there are so many businesses that are going to be closed down because of COVID, because they don't have an appropriate plan in place, right? And so as we talk about risk and risk management, an important part of managing that risk is being prepared for the future, being able to look ahead.
And also preparing for a rainy day, literally.
For a rainy day, right? Exactly.
And what some of that risk management can be saving. Like, you know, you obviously got to save a certain amount of your income. So when we don't see things coming, when we're, you know, the weather isn't forecasted the way that, or it doesn't play out to that forecast, that we're able to weather the storm, literally.
Yeah.
Yeah.
100%. All right. All right. And so on the second type of risk is it's classified as unsystemic risk, right? So this is the second category of risk. It's associated with a company or a sector. It is also known as diversifiable risk and can be mitigated through asset diversification. So this type of risk, we know going into the sector or the particular company that this risk exists, right? And so this is the risk that we know beforehand, and we have a lot more control over it. We can actually do things before we actually invest in that asset type. So who want to tell me or give me an example of a unsystemic risk?
Unsystematic risk.
Unsystematic risk, yeah. So Michael, you're the bright spark, so you already got your reward. So we're going to ask another student.
Okay.
Maybe I'll go.
All right. John Gill, how are you today?
I'm good. How are you?
All right. Good stuff.
Good. Could it be, I guess, if you're putting all your money into one singular company that all of a sudden tanks, or if they're not doing well, or, you know, you pick something that doesn't make sense for the situation and then it tanks, and then you've lost all your money because you could have put it into different places.
Yep. So that's the diversification piece. So that's achieving the diversification. But what would you say is the risk with that particular company that makes it unsystemic?
Oh,
like, what about that company or sector that's risky that you know before going in? I'll kind of give you an example.
Okay.
And when you think about the airline and when those planes were crashing,
right,
that particular company.
Right, I see.
Yeah. So
okay, so
yeah, go
something
ahead.
is obviously wrong, or you know, there's a certain situation happening, and then you all of a sudden invest in it. It's just doesn't make sense.
Yeah. So it's happening with that company, or it's happening with that sector, but you still go ahead and invest, right? So it's that type of risk that you foresee going into the investment, right? So and when you think about risk, and as you're walking through, thanks, John Gill. So thanks for that, for participating. So as you're thinking about investing, right, and you're talking about risk, so this is how you're gonna tell that person who tell us somebody always lose through investing. So you're gonna break it down. You're gonna say there is systemic risk and there's unsystemic risk. So we're gonna look at this investment and we're gonna say these are things that may happen that we can't control, right? Then these are things with this investment that we can control. But here's the thing that we're gonna do to make a difference. And this is when you talk about financial literacy and you talk about investment, it's a logical sequence of thinking. So a lot of people will say, I won't invest in this company because this exists, right? When I look at a company or I'm making an investment decision, I look at the pros and the cons. And if it is that one, let's say there's a particular particular con that I'm concerned about. So let's say I'm investing in a particular company and they have high debt, right? They have a lot of debt and I'm concerned about the debt. Then my thing is, I'd ask myself whether or not that company is able to overcome that challenge, right? So you always want to look, when you're making your decision, even though something exists as a risk or as a con, you have to ask yourself, can they overcome? Can they mitigate? Do they have things in place? Is it a short-term thing, a long-term thing? Or you can measure it, right? On a scale of 1 to 10, how risky is this? All right, maybe you would say, okay, it's a 2, it's a 3, or it's a 10, which is inherently and significantly risky. And if you've concluded that it's so risky, does it outweigh all the pros that exist, right? So you have to go through that logical sequence, and that's how you're gonna be able to manage risk. So when you talk about, even when you talk about OSAP, and a lot of people will say, oh, I'm not gonna take it on no OSAP. OSAP again is student loan because I don't wanna owe money. Well, you go through that process. What are the pros of taking on OSAP? What are the cons? Is there any risk, right? Is there systemic risk? Is there unsystemic risk? How can I manage those risks? So that's how you're gonna have to start thinking about your portfolio and about your investment, right? Because at the end of the day, OSAP is an investment, right? So when you talk about investment, you have to talk about how you're gonna manage the risk. That's the most important part. Again, like I said, everything we do is risky. What is gonna make the difference is how we manage the risk. All right?
So Farley and I have a phrase. I mean, it's not ours that we've coined, right? You catch that accounting reference that we've coined, but it's called cost benefit analysis, or we say CBA, right?
Yeah.
So you always got to do an analysis of what it's going to cost you or what you're going to gain. So either, you know, you're weighing the pros or the cons in terms of what you are going to be entering. And if
I put it in the chat earlier too.
Okay, absolutely. And if it's deemed that you're going to lose or you've got more to lose in terms of that risk than gain, you might want to think, not even think twice, you've got to think first. All right.
Yeah, and I mean, yeah, I completely agree. So it's the same thing. Like we, you know, in my program, I do a lot of cost-based analysis, the difference between two alternatives. You'll understand that certain things are more important to you. And I'll give you an example. One of the cases that is very popular in my CPA program is the decision to outsource, right? You know, outsourcing meaning getting somebody else elsewhere to do the work for you. And as a business person, you're always concerned about quality. And if it is that you're gonna outsource and the quality is gonna be compromised, then it doesn't matter how many benefits this thing is producing, the quality is most important to you. So it's a no outsourcing deal, right? And so when we're talking about cost-based analysis, if there is one thing that you come across, even though the cost, it might be 50-50, when you look at those, that one con or pro, and if there's something that it goes against your value or something that you don't believe in, then you might want to reconsider as well, right? So I like to stay true to my core values, right? And I see, and I mean, a lot of people invest, they chase money. Personally, I chase my core values. So there's certain things that I won't invest in. Like if there's an organization that's oppressing Black people, I'm not going to invest in it. It doesn't matter how much of a return it's producing because you're literally funding the oppressor, right? So you always want to keep what's important to you when you're making those decisions.
And that's why the research is important as well.
Yep, 100%.
Because, you know, there are companies out there who shall remain nameless at this point, but that have association with child labor and things like that. Your core values are absolutely integral to actually the joy that you're seeking from or happiness that you're seeking from money. So be sure that you do your research and you maintain your integrity.
100%. All right. So love the discussion here. So there are a few measures of risk. There's actually quite. So we've talked about some of the measures already. A lot of them are qualitative. And so we're going to talk about like some mathematical measures. I won't go into too much detail because I know math can be a challenge, and you know we can spend all day talking about these. But two of the most popular one is standard deviation and beta. So standard deviation is the measure of dispersion of data from its expected value, right? So
that's
really,
a mouthful right there, my brother. We have to break
exactly. All right. Yeah, it is a mouthful. So I mean, I was actually thinking quite consciously as to whether or not I should be including this slide, because standard deviation is not a concept that you can grasp without probably some background knowledge in statistics. Right. But let me see if I can simplify it. And Roderick, Farley, or Michael, feel free to chime in if you've come up with an easier way to like explain it. So again, so it's a measure dispersion of data from its expected value. So really and truly, so let's say you expect a certain outcome, right? So let's say, all right, I don't know, like,
you know what? I think we may just being conscious of time.
All right.
You may want to come visit this one next week and break down just even the terminology bit by bit. So like,
all right, sounds good. All right,
like,
so I'll leave that one. I'll leave that slide.
I think that probably deserves
so
it.
Let's move along.
Yeah.
Before you
right.
run, Andre, I venture to say what the standard deviation is what if everyone was to do the same thing, what is it they would do? If everyone was to be paid the same dollar for salaries, what would that salary be? So you may have a guy getting 10, another guy getting 20, another guy getting 50. But if all three persons was getting the same salary, what would that number be? And that's kind of what the standard deviation represents. And if you go there, you're likely to get this average, but it may be a little higher or a little lower.
Right.
But next week we can expand on it some more.
Yeah. And so lastly, what we want to talk about again, so the risk versus return trade-off. So when you're making a decision, you always want to focus on the risk-return trade-off, right? So even though there's risk, everything has risk, right? So, but you want to see if the return is worth the trade-off. And trade-off just means that you're giving up something for another, right? And you'll hear concept like opportunity cost, which is one thing forego for another, right? So you always want to think about what you're giving up and what you're getting in return. So if you even go back to the concept of barter system, if I'm going to give up a cow and you're going to give me a pound of rice, is that a fair trade, right? So what is it that I'm giving up and what is it that I'm getting in return? So that's another way that you can look at your investment decision. And so that's really it for this week. You know, I thought it was fitting to talk about risk because a lot of people in our community will say that they don't like risk, they don't take on risk. That is because they don't understand risk. So that is why we talk about it today. And as usual, I either have jokes, poem, or quotations, right? And this one that I have today is, I will tell you how to become rich. Close the doors, be fearful when others are greedy, be greedy when others are fearful. Warren Buffett. Be prepared to invest in a down market and get out in a soaring market. So that's really what that means. So like right now, everyone is panicking in March, everyone was panicking and fearful of COVID. And so everyone sold out their investments, stock price plummeted. And so you have those smart investors went in and they bought a lot. And as soon as the momentum came back and people start buying, the prices go up and they sold and they made millions of dollars. So that's really what that concept is.
And just on a different note, Andre, I think that one thing we have to continue reinforcing amongst our Black community is right now, there's a perfect storm brewing for Black people. right? It came about through unfortunate circumstances, but I'm telling you, if you are especially if you're an employee of an organization, this is the time to apply for promotions. Take the risk invest in yourself as someone who can gain from the momentum and the climate that exists right now for Black people. Don't sit back and watch the storm go by, because you will miss it. I'll tell you right now. So if you're in an organization that has not necessarily been as forthcoming and as forthright as they should be in terms of the opportunities within the organization for people of African descent, the awareness is out there now. Apply for positions that you've been walking by and thinking, oh, I'm scared to apply for that position, or I don't know if I fit, and this, that, and the other. Make sure you're ready, right? But take that risk right now, because now is the time. I kid you not. The last time this happened was about 60 years ago, and it was called the Civil Rights Movement. Okay? So now, if you think if you're going to wait another 60 years, I don't know. I plan to be around, but I may not be, right? But I'm not going to wait. You know what I'm saying? So,
and just to
one sec, let me finish.
Okay, yeah, sure.
Yeah. So in a nutshell, right, there's a lot of momentum going our way right now. If you do not ride that wave in terms of investing in the intelligence, the education, etc., that you've invested in yourself, then what is that investment? What's the return on that investment if you don't invest while the market is waiting for you?
Right. And the last point I wanted to make is that growth happens in discomfort, right? So sometimes we have to be a little bit uncomfortable, but taking these calculated risks. We need to take these calculated risks, but be a little uncomfortable to be comfortable, right? So if you think about anybody, whether it be LeBron James, he's got to do that 10 extra push-ups and, that 10 extra, running exercises each day to be the best in his field. So we've got to do the same thing. And anything that we do, we've got to just take it out of that comfort zone and be uncomfortable so that we can grow. And on that note, we are going to say thank you. But, the last thing before we leave, we want everybody to please share in the chat one thing or that you feel about this program. Just one word or two words that you can describe what this program offers to you, because we want to share this not just with our funders, but with the rest of the community, what Flip, Floss, and Fly shares with you every week. And again, we're challenging you to bring somebody next week. So this week we had about 40 people on the chat. Next week we want to see 80. All right, and we're going to do this. And we're going to make sure that our community is empowered and that we're informed to take our next generations to that next level. So without further ado, I'm leaving it up to you. Toronto shines, don't forget. And if you're not a member with the BDPA, please join us at bdpa.org. Become a member, give it as a gift, and we are going to grow this community one by one. That's about that.
Actually, you know what? I'm gonna put something on the table before we break out.
All right, let's do it.
So Rogers mentioned Toronto Shines. As you guys can see, I'm wearing the t-shirt. This is a project I'm doing in partnership with Ontario Place. And we have comedy, live music, and movies that we're showing every single weekend. Tonight, we have a beautiful, amazing R&B artist named Sean Jones. Those of you who've got the pedigree, you might remember a group called In Essence. He is one of the members of In Essence. He's performing with his band tonight. We're also showing the blockbuster film Ford versus Ferrari. And we've got a comedian named Kate Davis, who's also gonna be down at Ontario Place in what's called the East Commons. The person with the deepest, most meaningful response to Rod's question, hopefully you drive, because it is a drive-in, right? I'm gonna offer you a free spot in our parking lot tonight. And these tickets are very limited, folks. I'm gonna tell you right up. There's only 200 spaces available, right, in the overall parking lot, but I'm gonna hold one for the person that gives us the most deepest and meaningful answer. Unfortunately, you'll have to live in the GTA or have access to getting to the GTA by about 7 o'clock tonight. There's gotta be parameters on the lives we live. I would hate to say that, but that's the reality. All right, so the most deep and meaningful response as assessed by Roderick, Andre, Michael, and myself, right? We will make sure that you're on the guest list for tonight to enjoy an amazing experience. We've been on for 2 very successful nights. This goes all the way till October, right? But tonight, I think you guys will really enjoy what we have to offer in particular. All right?
All right.
So I actually came up with a tagline, but you know what? I'm gonna be responsible, and I'm not gonna use this tagline. But my tagline was, "I'm too spontaneous to quarantine." But you know what? I have to follow the rules. I'm gonna stay home because I'm under quarantine for 14 days. But you guys, everyone should go and participate.
Well, it's a fully safe environment. It's a fully safe. People remain in their cars. There's no interaction. Yeah, we manage the washroom visitations. The food is delivered by the Canadian skating team. They do it on inline roller skates. Bring your food to your car based on an order on your app. So there's no health and safety issues whatsoever. We have to be fully compliant. Again, in our community, I mean, this is something for the entire city, obviously. But as I'm speaking to Black people right now, our community's been impacted by COVID-19 much greater than everyone else's has. And that's globally a reality. So we have to make sure we're as compliant as possible with the guidelines. Right now, we're in phase 2 in Toronto. Those of you who live outside of the GTA, you might be in phase 3 in your community. But we got to be compliant, like I said. So once again, Rod said it already, but bring a friend next week. I'm going to push hard for this. We have to increase the numbers of folks who are gaining financial literacy in the Black community. It's critical.